All right, so you know how it is. You hear about some new thing in crypto and you're like, okay, I got to know more.
Yeah.
That's us today with Berachain. I mean, you sent over some pretty interesting stuff. Their website, this like deep dive document they call a honey paper.
Right.
And even some articles that try to like break it all down. And honestly, the big thing that jumps out is this whole proof of liquidity idea.
It really is a pretty radical concept when you think about it.
So what we're going to do in this deep dive is really unpack Berachain.
Okay.
See how they're trying to fix some of the big problems in blockchains, like, you know, making sure everyone's incentives are aligned, right? So like users, the people securing the network, the apps themselves, and then also figuring out a better way to get liquidity flowing. It's like rethinking how all the pieces fit together, kind of like the plumbing of DeFi, I guess.
Yeah, that's a good analogy. They definitely see the problems with some of these layer ones. And proof of liquidity is their solution.
Here's something that really surprised me. Berachain started as an NFT project.
Really?
Bong Bears, they were called. Rebased NFTs, a whole community.
Huh.
Not your typical origin story for a layer one, right?
Not at all. I mean, it does show they've had a strong community from the start, which is always a plus.
Okay, so big picture, what's Berachain trying to do?
Okay.
It seems like they're all about pushing value towards the apps built on their chain.
Yeah.
Like making it easier for these dApps to get going, get users and all that.
That's the key, because a lot of promising chains struggle with that.
Exactly, that chicken and egg problem.
Yeah.
But they're flipping the script.
Yeah.
Instead of the base layer sucking up all the value, they want the value to come from the apps, which then strengthens the chain.
Exactly. It's a really smart approach.
And they're going after two specific problems. First, aligning incentives. Users, validators, apps. Making sure everyone's pulling in the same direction.
Their honey paper makes a big deal about that. They say a lot of chains don't connect the rewards for securing the network with the actual demand for security from the dApps and users.
Right. They even give an example of a new chain. Like, shoots up to billions in valuation, but has hardly any real usage. TVL is tiny.
Right.
Yet it's still printing tons of tokens to pay stakers. Makes you think, right?
It does raise some questions about whether those incentives make sense. Are validators being paid for actual value?
Totally. And the second problem they're tackling is this idea that a blockchain's value should come from the apps, not the other way around. It's like they're saying Berachain's strength comes from how good its dApps are.
That's an important distinction. A lot of chains rely on the value of their token, which can feel disconnected from the actual usefulness of the apps. Berachain wants a tighter relationship,
where the apps make the chain stronger.
Right. Exactly.
And this brings us to proof of liquidity, or POL.
Okay.
This is their big idea, right?
Right, their answer to these incentive and value problems.
And they're doing it with two tokens, BERA and BGT.
Okay.
So BER, that's the gas token. You use it for transactions.
Right.
But it's also what validators stake to secure the chain.
So it has the basic functions we expect from a layer one.
Yeah, and they started with 500 million BR. With a chunk airdrop to the community.
Interesting.
Then there's BGT, Bearer Governance Token.
Okay.
This one's non-transferable, which is kind of weird.
Yeah.
But it's mainly for governance, you know, voting on stuff. But it's also how you get rewards. You stake BER, you get BGT.
Okay.
You stake in these reward vaults we'll talk about, you get BGT.
Interesting that it's non-transferable, though. What's the thinking there?
So they say it prevents just like speculators from hoarding governance power.
I see.
It keeps it in the hands of people actually using the network.
That makes sense.
And here's the thing. You can burn BGT to get BR, 1-to-1.
Okay.
But you can't go the other way around. So BGT becomes BR. But to get more BGT, you got to participate, stake, provide liquidity.
So it puts a premium on engagement.
Exactly. And this whole two-token thing, it's not just random.
Right.
They're explicitly prioritizing users and apps over just basic validator rewards.
It's a real shift in how we think about incentives.
Okay, let's get into proof of liquidity itself.
All right.
It's proof of stake at its core, but then they add stake and boost.
Okay, what's the difference?
So the active validators, the ones who can make blocks, that's determined by how much BR they stake. Top 69 get in.
So that part's pretty standard for proof of stake.
Yeah, and your chance of making a block depends on your stake.
Right.
But the size of your reward, that's where boost comes in.
Okay.
It's all about how much BGT has been delegated to you.
So the more BGT you have, the bigger your reward.
Exactly, like a multiplier on your B or stake.
Yeah.
And the reward's paid in BGT.
So that's a big incentive for validators to get people to delegate to them.
Big time.
Yep.
And validators get a little commission in beer for each block, too.
Oh.
Just to cover their costs.
I see.
Now, let's talk about these reward vaults. Kind of like loyalty programs in DeFi.
Okay.
You stake specific tokens, like LP tokens from a DEX, and you earn BGT. It's how validators share their rewards with users.
So like curves gauges.
Exactly.
Sure.
So an app can create a vault, users stake their proof of participation tokens, and bam, they're earning BGT from the validators.
It's a direct way to reward the behaviors the app wants to see.
Right. And the app can even sweeten the deal by offering their own tokens to validators in exchange for sending more BGT to their vault, like bidding for emissions.
Oh, wow. So it becomes this whole marketplace for incentives.
Totally. And the app sets the exchange rate.
Okay.
So they control how efficient or how spread out the rewards are.
That gives them a lot of flexibility.
So where do the validators fit in?
Yeah, what's in it for them?
They stake BER for basic security, but the big rewards come from BG2 boost.
Right.
So they're incentivized to get more BGT delegated to them, and then to find the best places to swap that BGT for those juicy app incentives.
So they're not just sitting there, they're actively looking for the best deals.
Exactly. More active, potentially more profitable.
Interesting.
Now, about BGT and BGT.
Yeah.
How do they work together to keep things balanced?
Okay.
So when the value of those app incentives is high, people don't want to burn BGT for BG. They'd rather hold on to it for those rewards.
That makes sense.
But if incentives drop or demand goes down, people might start burning BGT for BD, which reduces BGT supply, making the remaining rewards more valuable.
I see.
And that could drive demand for BGT back up again. It's like a cycle.
It's like a self-regulating system trying to find a balance.
Exactly. And unlike some DEXs where new tokens come from outside the core function, Berachain's emissions are tied to the chain itself, like proof of stake.
Right. It's not about creating endless inflation.
Yeah, it's more about directing existing emissions towards useful things.
Interesting.
Let's look at some examples. The Honey paper talks about their own AMM, BEX.
Okay.
Anyone can create a pool, and through governance, those pools can get BGT rewards. So a new app launches, they make a pool for their token on BEX.
Yeah.
And then they create a reward vault for that pool's LP tokens.
Okay.
Users provide liquidity, stake their LP tokens in the vault, and earn BGT.
So they bootstrap their liquidity using the chain's rewards.
Exactly. And they can go further by offering their own tokens to validators to send even more BGT their way.
It's a clever system.
And they control the exchange rate so they can fine-tune their strategy.
That gives them a lot of control.
They also talk about real-world assets. RWAs. Like imagine tokenized T-bills or real estate.
Okay.
With Pol, you could have a vault for those tokenized assets.
Interesting.
So holders earn BGT on top of the underlying yield.
That could make bringing real-world assets on-chain a lot more attractive.
For sure. And they even suggest using Pol to incentivize the originators of those RWAs.
Oh, wow. That's a whole other level.
And then there's the layer 2 angle.
Okay.
Berachain's fast, but L2s can scale even further.
Right.
So imagine you bridge assets to an L2 built on Berachain.
Yeah.
Those assets could be staked in a Pol vault on the mainnet.
Oh, I see.
So you earn BGT rewards on the main chain while using the L2.
That's a great way to incentivize both L2 adoption and mainnet liquidity.
Totally. And the L2 could even create a vault for their own token on the mainnet.
Wow, it's like a whole ecosystem of incentives.
Back to the validators real quick.
Okay.
They're staking BER, competing for BGT boost. What drives their decisions?
Well, they want the most valuable and liquid incentives they can get for their BGT. So they're looking for the best deals, any arbitrage opportunities.
It's not just about raw BGT. It's about directing it wisely.
Exactly. And to attract that BGT, they got to offer good commissions.
Yeah.
Keep their nodes running smoothly and have a smart voting strategy.
Right. They got to prove they're valuable to the network.
And in the end, their profitability depends on how much boost they have, how efficiently they swap their BGT, and their commission rate.
It's a lot more active than your average validator role.
Definitely.
Berachain has their own dApps too, right?
Yeah, they have BEX, the DX we talked about. Bend, a lending platform that uses their stablecoin Honey.
Okay.
And BRP, a perpetual futures trading platform.
So they're putting their money where their mouth is, showing how Pol works in practice.
Exactly. They're not just talking about it, they're building with it.
Now, about BeaconKit. That's what Berachain's built on, right?
Right.
What is it, and why did they go with this EVM-identical approach?
So BeaconKit is a framework they built using the Cosmos SDK. And it's designed to create these EVM-identical clients.
Okay.
Meaning they use the same execution clients as Ethereum, like Geth, Reth.
So Ethereum developers can just jump right in, no problem.
Pretty much, yeah. That's a huge advantage for attracting developers and projects.
Makes sense. And it makes upgrades easier too, right?
Yeah, they can just adopt Ethereum's upgrades, like Denkun. Plus, they support all the Ethereum RPC namespaces, which is great for developers.
They also mentioned that BeaconKit allows for immediate execution and optimistic payload building. Faster block times, better finality. How does that work?
Basically, validators can start agreeing on changes to the blockchain state.
Yeah.
Even before they fully agree on all the transactions in a block. It speeds things up a lot.
Interesting. And it helps with integrating Ethereum improvement proposals, like EIP 4788.
Right. That one lets the execution layer verify consensus layer data.
Important for security and cross-layer communication.
Absolutely.
Okay, let's talk governance. We know BGT holders are in charge, but what decisions can they make?
Pretty much everything. They can decide which tokens are allowed in the reward vaults, tweak the parameters of the pool contracts, and they have full control over the entire Berachain application.
So they're really steering the ship.
Yeah, it's a very community-driven project.
How does the process work, proposing and implementing changes?
So there's a proposal phase, then voting, and then a time lock. This time lock is key. It gives everyone a chance to review things before anything goes live. It prevents hasty decisions.
That makes sense. And they have different roles in governance, holders, proposers, delegates, guardians.
Right, each with specific responsibilities. The guardians, for example, help protect the network at the DApp level.
And there's the governor and the time lock executor to make sure things run smoothly.
Yeah, they've built a pretty robust system.
Now, every blockchain has its risks. What about Berachain and Pol?
Well, like any proof-of-stake system, there's always a risk of centralization, especially from those with a lot of capital.
We even talk about this end-of-Pol scenario.
Yeah, where validators collude to take all the rewards.
Making BGT holders burn their tokens instead.
Which could kill the whole proof of liquidity thing.
Yeah, but then new validators could come in and offer better deals, right?
Right, the market could self-correct.
They also mentioned the issue of high beer lending rates.
Yeah.
Potentially leading to less staking and more BGT burning.
But they think that would be temporary. Things would rebalance eventually.
What about the risk of a giant liquid staking provider like Lido on Ethereum?
That's always a concern.
Yeah.
But Berachain has a cap on staked BA.
Okay.
And a function that makes gaining more BGT boost less and less effective.
So there are some safeguards in place.
Yeah, they're trying to mitigate those risks.
And of course, there are the general blockchain risks like insufficient staking, governance attacks, and the risk of parameter changes in the future.
Those are pretty much unavoidable in any decentralized system.
So to sum it up, Berachain is this EVM-identical Layer 1.
Yeah.
Using Proof of Liquidity and BeaconKit to try and fix these liquidity and security problems we see in other chains.
They're aiming to find a better balance between security, decentralization, and a thriving application ecosystem.
We've talked about Area, the gas and staking token, and BGT, the governance and rewards token you get for participating.
It's all about empowering users and applications to be a bigger part of the network.
Their goal is to really push the boundaries of what dApps can do and create new financial tools we haven't even thought of yet.
It's a pretty ambitious vision.
And they're live. Mainnet launched back in February 2025.
Wow, so it's all happening right now.
With an airdrop to early supporters, it's a real working network now.
That's exciting. We get to see if these ideas actually work in practice.
For me, the big takeaway is that Proof of Liquidity is a totally new way to incentivize participation.
Yeah, it's not about just holding tokens. It's about actively contributing.
Users, validators, apps, all working together more closely than we've seen before.
They're trying to create a more cooperative system where providing liquidity is directly rewarded.
This deep dive has given us a good understanding of how it all works.
Yeah.
And it'll be really interesting to see how it plays out, whether it lives up to its potential.
I agree. The whole blockchain space will be watching closely.
So here's something to think about. Could this proof of liquidity idea, this idea of rewarding participation and aligning incentives, work in other decentralized networks, maybe even outside of blockchain?
That's a great question.
Could it improve real-world economic systems? Something to ponder. We encourage you to check out those sources we talked about and keep exploring these ideas. This is just the beginning.
It's going to be interesting to see where it goes from here.
Absolutely.